Ever wonder why some IPOs seem perfectly priced while others skyrocket or flop on their first day? It's not just guesswork or luck. Discover the fascinating process behind setting an IPO price and why it's crucial for both companies and investors. Welcome to our deep dive into the world of IPO pricing. If you've ever been curious about how companies pick the starting price for their stock, you're in the right place. We'll explore the meticulous process that determines these numbers and reveal why it involves much more than just throwing darts at a board. From hiring investment banks to conducting roadshows and analyzing market trends, it's a complex but fascinating journey. In this video, you'll learn about the key steps involved in setting an IPO price, including the roles of underwriters and big investors, the importance of demand and market comparisons, and what happens once a stock finally hits the market. By understanding these elements, you'll gain insights into why some IPOs succeed and others falter. Let's start by understanding the basics. IPO stands for Initial Public Offering. It's a big day for any private company deciding to go public by offering shares to regular investors. This means people like you and me can finally own a small piece of the company. But before this exciting day, the company has to choose the IPO price, the starting price for its shares. Now, this isn't just a random number. There's a whole strategy behind it. The IPO price is determined by how much investors are expected to pay for a single share on the opening day. But the company doesn't venture into pricing blindly. They collaborate with investment banks, known as underwriters, such as Goldman Sachs or JP Morgan. These underwriters are the masterminds behind preparing the company for the public sphere, pitching the IPO to significant investors, and ultimately setting the price. Think of them as essential coaches guiding the company through this transformational journey. A crucial step in this process is the roadshow, a series of presentations mostly conducted online nowadays, where the underwriters and the company showcase their business to potential big-money players. This includes discussing their financial performance, business model, growth prospects, and market potential. These investors provide valuable feedback on what price they'd be willing to pay per share, which is crucial in ensuring the IPO is neither too high to scare away buyers nor too low, leaving potential revenue behind. Additionally, the company and its underwriters analyze market trends, particularly focusing on similar companies that are already on the stock market, known as peer companies. They delve into metrics such as price-to-earnings ratio and growth rate, trying to understand the current investor mood and appetite. This evaluation helps them justify the company's valuation and determine a fair IPO price. The final IPO price is decided the night before trading starts. Based on the interest gauged during the roadshow, the price range might be set, for example, between $32 and $36 per share. Strong interest might push the price to the higher end. Weaker demand might lower it. Once trading begins on platforms like New York Stock Exchange or NASDAQ, the dynamics of supply and demand take over, often causing the stock price to fluctuate significantly. This unpredictability is why you see dramatic headlines about stocks surging post-IPO. Regular investors, however, seldom get to buy shares at the IPO price. Most initial shares are reserved for institutional investors or the hefty-pocketed players. By the time the general public gets access, the price has likely adjusted to reflect market demand. In summary, picking an IPO price involves a blend of art and science, carefully balancing investor enthusiasm with pricing strategy. So next time you hear about an IPO, you'll understand the extensive groundwork that culminates in that initial number. So, IPO pricing isn't just a random number. It's a careful balance of investor sentiment, market analysis, and strategic planning. We explored how companies hire underwriters, conduct roadshows, and analyze market comps to set a price that reflects demand and potential growth. Remember, IPO pricing is both an art and a science, seeking that perfect equilibrium where companies raise capital efficiently and investors find value. Now that you know how IPO prices are picked, what do you think is the most crucial step in the process? Is it the market comparison, investor feedback, or something else? Share your thoughts in the comments below, and don't forget to like and subscribe for more insights on the stock market and investing.